Hello, YouTube. The parallels between 2008 over here on the left-hand side and 2022 over here on the right-hand side continue to tell us that our pattern is currently repeating history. And if that is correct, it means we are now entering the danger zone or the yellow box where we are looking for a few more weekly higher highs and then we're looking for a nasty drop. So specifically, what we're going to look at is the current pattern here. We go back to 2008. We formed 8 consecutive weekly higher highs. 1, 2, 3, 4, 5, 6, 7, 8. Then we got a little bit more up, and then we go down. If you remember from last weekend, we were talking about how the bears were going to make a big mistake. And I think that we now are getting a lot more evidence that they were wrong, because if we count here, we got 1, 2, 3, 4, 5 back-to-back weekly higher highs. And by closing at the high of the week, we are likely going to get a 6th. So if history is repeating itself, and we know that we're closer to the top than we are to the bottom, we really have to pay attention this week. There are some very big clues in terms of where we could backtest, where we could close the week out, which we will review a little bit later. And if you wouldn't mind smashing the thumbs up to show me some support, it really means a lot to me. Might seem like something really small, but it tells YouTube that you enjoy the content and they should go tell more people about it. Thank you so much. Appreciate all your support. Looking here to one more indicator of 2008 versus 2022, we have VIX. And VIX is crashing down. It's currently at 22. And this also tells us that there's going to be a period of a few more weeks into December where we see VIX come down even more. People start to breathe a sigh of relief, and then boom, right in the kisser. That's what I'm going to be watching for, the VIX closely. Right now, the VIX is at 22, and we will circle back to look at this chart a little bit later. So I just want you to keep in mind that the SPY or the chart is currently telling us that, yep, we're on track. And over here in 2008 for the VIX, we're also on track. Why would this be happening? Why are people not scared anymore? Because the VIX is really a fear index. Well, people think the third time's the charm. So the S&P is now staging its third 10% recovery during 2022's bear market. In March, we rallied up by 11. In June, we rallied up by about 17. And off the October low, we're currently up by about 12. So that is very obvious when we now look to the fear and greed. Keep March, June, and October in mind. Why? Greed is extremely high right now. Let's look here at our timeline to see what happened in March, June, and now October. That's right. The March top was 62. The June top was 68. And where are we right now? We're up here at 66, Justin. That's correct. So our short-term top was formed here in late October at about 61, 62, which is the March high for fear and greed. And then it came crash landing down. We look over here to where we are now at 66. Well, we're matching July. So the market's going to have a fresh leg higher in greed, or we got to find some equilibrium, maybe a topping out pattern where we go sideways a little bit. So that is like really important for us to keep in mind, because right now it's looking like maybe people are getting greedy just like they were in 2008. Keep that in mind. The chart is important here. It's not the story that we want to just say is the Bible, though. The fear and greed is a part of the story. It crafts the narrative. It does not mean it is also the Bible. Wall Street's outlook for the S&P 500 earnings is getting gloomier. And this is actually what I believe could cause the next leg lower, but we're going to defer this. Why? Because it's Q4 earnings. Q4 earnings are going to be a look back to the fourth quarter, which ends when? December 31st. So the December 31st is going to be the reason why maybe we go down into the next year. Yes, but as of right now, I still believe the reason why we're going to top out into mid-December is that we have an FOMC meeting coming up. And there's an asterisk here, which means we're going to be provided with a summary of economic projections. I still think it's premature to talk about a pivot. I think right now we're talking about a pause. One more thing I want to leave you with is that when we think about an actual pivot, not a pause. Again, the Fed right now is telling us we're not even ready to pause, let alone pivot. They're slowing. They're tapping the brakes, basically. And when the Fed pivots, that doesn't mean the bottom's in. It means we're actually looking for the flush or the final exhaustion lower. This goes back more than 50 years. Negative 36, negative 48, negative 30, negative 50, negative 60, negative 35. So yes, if we're closer to forming the bottom, well, we have to see the Fed pivot, which means things are now actually getting bad. The Fed is going to pivot or blink because things are breaking. Look at what happened with FTX this week. There could be fallout. I don't think it's systemic, but anyways, if the Fed does start to pause or pivot, that doesn't mean we get all systems go. We have to see some capitulation. So what would that mean? Well, I believe in December 13, 14, the Fed is going to say one data point is nice. It is not enough, and we're going to have to stay on course. Where we could meet some drama this week is also going to be with inflation. We've got PPI coming in from manufacturers on Monday. We got CPI out of Great Britain coming in at 10.6 estimated on Wednesday, and that would be an increase from the 10.1 we had before. Let's zoom in here to make sure you can see it. So on Wednesday, we got CPI coming in for Europe, for Great Britain, 10.6 or a higher high. Cool. Core CPI out of Canada, expected to come in 0.4. We'll see what happens. CPI out of Europe, a double top maybe, 10.7. Again, double-digit inflation. Haven't even hit winter yet. Come on. That's where I think we could meet some stories of, well, maybe inflation's peaking in the U.S., but if it's not peaking in the world, is it real? Yeah, is it real? And then if we're going to keep rallying, what I want to pay attention to is going to be what it tells us here. So consensus estimates now expect negative S&P 500 earnings in the fourth quarter. What would that be? A first quarter in a recession being 2 quarters of negative contraction. So let's just read a small part of this article here. As inflation peaks, companies where earnings were supported by rapid margin expansion are potentials at risk. The sharp increase in ups from companies' inflation was a significant portion of earnings beats this year. Even the lowest quality and lowest pricing power companies were able to pass on costs. Although the current earnings cycle fared largely better than expected, several strategists worry that earnings will get a lot worse and reflect the economic outlook. Q4 earnings were going to be disastrous, but I think that's maybe going to be the bottom. Maybe then we can start to see things slowly turning around as we go into 2023. There you go. That's the most important thing for right now, is that's going to be deferred until later. That's not a problem for right now. That's Q4 earnings looking back. And if you wouldn't mind smashing the thumbs up if you haven't already, I would greatly appreciate it. It means a lot to me. Thank you. So what that means is the companies that did the best during low inflationary environments or during the lockdowns would mean maybe those are the ones that are going to get hurt. We're going to look at the heat map now, and then we're going to look at some charts to try to understand what is actually happening. You look here at the 1 week, the stocks that are up more than 10%, again, Microsoft up 13, Google up 13, Amazon up 10, NVIDIA up 16, right? AVGO up 13. It's largely tech that is way outperforming. But now, if we zoom out to a 1 month, what happens? I notice a theme here. It's green everywhere, but the ones that are red are flashing a warning. Google red, Meta red, Amazon red, Tesla red. And this is really big divergence because most stocks here are up. Again, if we look at the leadership, Microsoft, Apple, the two companies who emailed me this week to say that we're jacking up prices again, O365 going up, Apple One going up. Anyways, not up 10%. Microsoft's up 9.6, close to 10, but not quite 10. Apple up 7.6. So if the gains we saw in the last 1 week continue, that is fantastic. It's what we need because these are the laggards. If you look at the last 1 month, Berkshire's up 16, Cisco's up 13, NVIDIA's up 41, right? What do we got here? CRM, right? Salesforce is up by 10, Oracle up 24, Procter & Gamble up 12. The laggards are the trillion-dollar companies. This looks like a problem to me. And we're going to see that in the charts when we look here a little bit closer. Last thing I want to look at here before we go further is just what happened in 2008 versus what could happen now. So we look back here to 2008. We note that we had this box right here where we have a massive violent week closing at the high, and then we form a back test. So just look here to see where the lower wick actually tested to. It tests to roughly the real bodies from the previous candles. If we now look to where we are in 2022, what would that mean? Well, it would mean that we're going to be forming, again, we can test as low as about 390 on SPY, a key area, 390 or 3900 SPX. So I would expect we're going to get a back test, and then we're going to find out. What I'm less confident of is whether we start the week off week with a gap down, a push down, and then close at the high, or whether we gap up. I don't know, right? We got FTX drama. We've got inflation coming in 3 days this week. I honestly don't know. I'm just watching for a range. I think we're going to get a higher high because we're closing at the high of the week. I also think we're going to get a test down to 390. That would be healthy for this market. So if that's where we currently are, and we're looking for either a little bit more up or a move down, as we now look here to some of the most important charts, meaning the ones that really drive the market, I want you to pay attention to leadership. Look at where S&P is relative to its 50 weekly moving average, or the blue line. We have to rally up by about another 5% to get there. If you look here to QQQ or the NASDAQ, we have to rally up by about another 13%, which is why when we looked at the heat map, it is not like a nice to have for the NASDAQ to go up. It has to go up right now. It cannot stall out. Why? This falling wedge pattern is bullish if it gets continuation. And on the monthly chart, I could see it going to 300. On the weekly chart, I could see it going to 300. But we're still about 20 points shy of getting to that 50 weekly moving average, or the short-term price. So right now, we're trending down in the short term, but trending up in the long term. That's the 200 weekly versus the 50 weekly. So if tech is the big laggard, and what it really comes down to is going to be whether or not we're seeing rotation. Why would rotation happen? Well, as we just talked about, the environment for the last 2 years, but really the last 10, has been tech, tech, tech. Low rates, high growth, blah, blah, blah. But if we're going into another cycle, what I want to watch for is going to be what happens to the leadership of today. Right now, leadership of today is the Dow. Look at this, over its 50 weekly. That's bullish. Industrials. We look here to the Russell. Well, a whole lot closer to its 50 weekly than it is not. And this is 2,000 small cap companies, which don't have as much pricing power as the $1 trillion companies, but they're recovering faster. They're looking stronger. RSP, or equal weight S&P, butting up against its short-term price, or that 50 weekly. These are equal weight S&P 500 stocks, basically meaning tech is not as heavily weighted. Now we look here to New York Stock Exchange, or 2,000 stocks. 2,000 stocks are more bullish than the S&P 500. Come on, tech. We need you to participate. Look here to XLK. Yep, same thing here, right? Tech, and it's got a big hole here to get to its 50 weekly. That's the really big glaring issue for me. We look here to ARK. Beautiful week. Cannot discount it. Up 15%. Bullish engulfing, but it has to go up an additional 35% to kiss its 50 weekly. Hundreds of millions of losses for the short sellers this week. There is still a lot of upside potential. XLV, it's flagging here on its 50 weekly. That's bullish. Healthcare is bullish. Look here to financials. Closing over. Again, financials are more bullish than tech, usually inversely correlated. Crap. Yep, crap. Looking to energy, bouncing sharply off the 50 weekly and going higher. Then as we look here to XLU, it looks a lot like the S&P. This could signal peak inflation. It could also signal that people are just not really looking for safety anymore. They're looking for the leadership of tomorrow. That pretty much gets me through my list. A few more things to look at are going to be, we want to look at the dollar. And the dollar right now shows me that we're going all the way back to an area we have not seen since the late 1980s. So if we're now backtesting 106.5, which is that key area I was looking for, are we going to bounce here, which means it's going to hurt stocks? Or are we going to go down further closer to 100, which will help stocks? This is really important because the dollar's down by about 4% this week, and the S&P was up by about 5.5, I believe. Let me just double check. 6%. So 2/3 of the gains on the S&P actually came from the dollar going down. So if the dollar flattens out or goes up, that will add pressure. If it's going to go back up higher, if it goes down, that could cause the market to go even higher, right? Come down to 103, maybe 100. That would cause the dollar to go down, but stocks to go up. So there you go. I'm looking here to the VIX. It's also now back down to 22, which we just showed you earlier, starting to repeat that 2008 cycle where we get low inflation and then, oh my goodness, it catapults higher. And for me to say there is a true market bottom right now, I need to see, not want to see the VIX. I need to see the VIX at least at 40, maybe closer to 60 to 80 to say we've truly formed our bottom. In 2008, we went as high as about 80. And then here in 2020, we went as high as about 85. So actually here we went to 96. So we have to get a lot higher than where we are right now. VIX below 20 means Market doesn't really care. It's complacent. It does not care. So that's like really important. Looking at the 2-year note, we're currently battling for weekly levels here, going back to 1998 and 2006 of about 3.8 and 5.2%, just the numbers here that are colored. And we currently have a really solid uptrend, which means that we're catapulting higher. We've got a golden cross. And we have to stop going up before we can expect it to go down, which means inflation has actually peaked, not we're front running the Fed and fighting them. Looking here at the 10-year note, we do have a weekly bearish engulfing candle closing at the low of the week, which would signal there is maybe more downside ahead. It's not confirmed yet, but that's what the odds tell us. What I really want to focus on here, is long-term inflation expectations, meaning on a monthly perspective, because when from 1980s to basically 2022, we respected this channel or the pink lines, which means inflation was going down, a deflationary environment. Well, that all changed back in March of 2022 when we broke out. And where do we go to? Our lows. So we're testing the relative lows at about 4.1 and 3.1. So these are people voting with real money for the long term. This is a 10-year note. You got to hold on for 10 years. And they're voting and saying, hey, it's nice that we're down, but we still think inflation is going to be quite high. So what I would need to see is for this to come back down, lose the 3 area, lose the channel, and fall back inside for me to really say inflation's been conquered. Until then, the onus is on the again, on the market to show us the data that inflation's actually peaked. Until then, we're range bound. We're range bound between resistance and support at about 3.1 and 4.1. Remember, the Fed wants 3% if we're going to get closer to 2. If we're not going to sustain a 4, maybe we have to go to 5 or 6% terminal rate. We will find out in December 14th when we have that FOMC meeting. So if we now think about all this and we look at where we are, we need to come back down to 3%, have to come back down to our 200 weekly, our 50 weekly, but that could really just be a head and shoulders pattern before we actually have longer term inflation actually go up. So what I am not sure about is where we're going to exactly go from here. So to recap one more time, what I'm looking for, I'm going to go back here to SPX on a 1-week chart, and we're going to look here to our pattern versus 2008, which we got up right here. Let's just clean it up a little bit. And then I just want to leave you with a little bit of a preview. So we know we're really similar here. Now we're going to drill down on 2008. So what I'm talking about right now is I'm much more confident in 2 patterns here than the longer term drop. So there's 3 patterns I'm looking at here. The first one is this topping out pattern, or what I just called in the today's video, the danger zone. Then we get the drop, which is going to happen here, and then we get the dead cat bounce. So what I'm more confident on is we're going to go down, go back up. What I'm not sure about is this move lower right here. I think we need to a TBD, right, to be determined, because stuff is already starting to break. And when we hear from the Fed on December 14th, that was the reason why I'm saying I think we're going to top out. So if the Fed says, actually, we're tapping the brake, we're not pausing, we're not pivoting, we're not going on the gas, we're tapping the brake, which means we're going to continue to hike. 50 basis points would be more. And if they raise their terminal rate, which means they think inflation is going to be running hotter for longer, they're not gonna keep it where it is. They're gonna have to raise their inflation terminal rate. If that confuses you, all you need to know is that right now, I believe that this move right here, the topping out pattern leading to, let me just delete the stuff on here. You can see the part I'm specifically looking at. We're gonna ignore the big drop, the 50% for now. What I'm more focused on is right now, I think we're topping out, which means I think we're in the danger zone. We're gonna do this, and then I think this is gonna be Fed induced. And if it's Fed induced, the timing also lines up that around the low here, this is when we're going to hear from earnings in January. January earnings are going to be looking back to Q4 and telling us whether or not we're seeing that earnings capitulation or if we're actually going into recession, which is where we showed you. The Fed pivot actually signals more downside for equities. So with that said, if you've enjoyed today's video, I would really appreciate it if you could take a moment to smash a thumbs up. And if you want to go back and watch last weekend's video where we told you the bears are about to make a massive mistake, that'll be queued up now. If not, thank you so much for watching, and I wish you all the best of luck this week. Thank you.